London, April the 29th, 2026. Overnight, a prediction market contract asking whether silver, August, would reach $79 in the week of April the 27th saw its probability collapse by more than 10 percentage points. It stood at approximately 34% 24 hours ago. Today, it prints at 24. That is not noise. That is a signal. And the mechanism behind it runs directly through the stalled corridors of nuclear diplomacy. The catalyst, when you trace the wire, is unmistakable. A single headline dominated precious metals trading this week. Gold and silver slid sharply as news emerged that United States and Iran nuclear negotiations had once again stalled. To understand why precious metals moved, you must first follow the crude oil channel. When diplomatic progress appears credible, energy traders price in a future where Iranian barrels return to global markets and crude falls on the anticipated supply increase. When those talks collapse, or in this case simply lose meaningful momentum, crude rises on renewed supply risk premium. That is precisely what occurred. Brent futures climbed as diplomats in Oman failed to bridge the fundamental gap between Washington's demand for zero enrichment and Tehran's position that enrichment is non-negotiable sovereign territory. For gold and silver, rising crude would ordinarily imply inflationary pressure, and gold, historically, is the inflation hedge of last resort. Yet precious metals moved in the opposite direction. The mechanism, as ever, is the dollar. Geopolitical risk drives capital into U.S. Treasury bonds, lifting yields and strengthening the currency. Since silver is priced in dollars, a stronger dollar mechanically suppresses its price. Silver, which straddles industrial and investment demand in roughly equal measure, felt the full force of that dynamic, and it shows clearly in the probability move. What does a 24% probability actually tell a macro analyst? The first thing to note is that this is, by any conventional definition, a tail risk contract. Silver at $79 would represent an extraordinary extension beyond current trading ranges. The metal has not sustained prices anywhere near that level in the present macro cycle. At 24%, the market is communicating something precise, unlikely, but not negligible, roughly a 1 in 4 chance that an extreme outcome materializes within a narrow weekly window. But the more revealing figure is not the absolute probability. It is the velocity of change. A 10.5 percentage point decline in a single 24-hour session indicates that market participants updated their beliefs sharply, and sharply in one direction, in direct response to new information. That is what well-functioning prediction markets do. They reprice efficiently when the fundamental narrative shifts. There is, however, a critical caveat embedded in the mechanics. The 24-hour volume for this contract registered at 0, and liquidity stands at 0. This is a thinly traded, speculative instrument. Price discovery is occurring entirely through probability signals, not through deep institutional order flow. That distinction matters considerably when assessing how much weight to assign the magnitude of the move. A 10-point swing in a liquid market is categorically more informative than a 10-point swing in one with no active trading. Here is where the analysis sharpens considerably. The smart money flow signal for this contract is unequivocal: sell. In the framework of prediction market analysis, smart money signals track the behavior of accounts with demonstrated forecasting accuracy across extended time horizons. Think of it as the equivalent of watching which macro hedge funds or sovereign wealth managers are expressing directional conviction versus which participants are simply reacting to the morning headlines and chasing momentum. When sophisticated, well-calibrated forecasters move to the sell side on a contract, they are communicating a clear view. The underlying event is less probable than the current price implies. In this context, the sell signal reinforces the fundamental narrative with considerable force. Those with the strongest track records of accurate forecasting believe that 24% still materially overstates the probability of silver reaching $79 this week. The reasoning, when you work through it, is straightforward. Silver at that level would require a very specific and narrow macro constellation to emerge within days, a meaningfully weakening dollar, rising inflation expectations, and constrained supply. The stalled Iran talks paradoxically remove rather than add to the conditions that Constellation demands. A stronger dollar follows safe haven demand into treasuries. That is precisely the opposite of what silver bulls require, and the smart money, it appears, has reached precisely that conclusion. Silver's relationship with geopolitical tension is considerably more complex than gold's, and that complexity is visible in this episode. Gold is primarily a safe haven and monetary reserve asset, responsive to fear and real yield compression. Silver straddles two worlds simultaneously. Roughly half of annual global silver demand is industrial, solar panels, semiconductors, electric vehicles, medical equipment, and half is investment. When geopolitical risk spikes sharply, gold typically rallies as capital seeks defensive positioning. Silver may follow in the initial move. But if the underlying risk event carries deflationary implications, a demand shock, a recessionary signal, a stronger dollar, silver tends to underperform gold in a material and sustained way. The Iran nuclear file has produced several comparable historical episodes that macro forecasters would do well to recall. In 2015, when the JCPOA deal was struck between Tehran and the P5+1 powers, crude oil fell sharply on the prospect of Iranian barrels returning to markets. The dollar strengthened on reduced geopolitical risk premium, and precious metals sold off in tandem. In 2019, when the United States reimposed maximum pressure sanctions on Iran following Washington's withdrawal from the JCPOA, silver was volatile but ultimately failed to sustain any material breakout above established technical resistance. The consistent macro forecasting lesson across these episodes is the same. Silver at extreme price targets requires a specific and narrow constellation, genuine dollar weakness driven by Fed dovishness, rising inflation expectations, and constrained mining supply. A geopolitical catalyst alone, operating in isolation, is rarely sufficient to produce a sustained breakout. Three signals will determine whether this contract recovers any lost ground or continues its decline toward negligibility. First, and most immediately, watch the Iran nuclear talks. Any credible resumption of negotiations, particularly if Tehran signals even marginal flexibility on enrichment levels, would reprice crude oil lower, soften the dollar, and remove one of the central headwinds pressing silver down. A ceasefire in any related regional theater could produce a similar dynamic through the risk premium channel. Second, monitor FOMC communications with particular care. Fed rate prediction markets are currently pricing a hold through June, which anchors dollar strength and constrains the dollar weakness thesis that silver bulls require for an extreme price target to be plausible. Any dovish signal from Federal Reserve Committee members in speeches, in the minutes, or in forward guidance would shift that calculus materially and is worth tracking closely. Third, watch Chinese industrial demand data. China is the world's single largest consumer of silver for industrial applications, and any meaningful fiscal stimulus announcement from Beijing carries direct implications for the metal's demand floor and, ultimately, its price trajectory. If this kind of macro forecasting analysis, rooted in geopolitics prediction markets and probability-based signal reading, is useful to you, subscribe to this channel. We track these signals every week.